Nancy, it does look like we have a couple people. Just wanted to let you know that you can kick it off then whenever you're ready.
Sure. Well, unfortunately, I can't see folks here, but I want to thank everyone for coming. We do have about 7 or 8 participants on the line, and my name is Nancy Valley. I'm from the Wilmington-Tewksbury Chamber of Commerce. I'm the executive director here, and I am very excited to have MP doing this presentation for us. It's something that there's still a lot of confusion about out there with our business community, and for the chamber itself, it was a couple months ago, and we really delved deep into the whole ERC, and we were able to find some funds for ourselves as well. So I do think it's extremely important. I want all of our business community to know about this and to research the options. And one of our newest members, MP, had offered to put together this webinar for us. So again, thank you very much for that. And without further ado, I'm just going to kick it off and introduce Paul Corellis to you. Paul is VP of HR Services at MP, and Paul has over a decade of experience in the HR consulting space, working with businesses of all sizes and industries. Paul and his team of certified HR professionals at MP assist clients with compliance, training, and full circle HR guidance and support. So without further ado, Paul, thank you again, and I'm going to turn it right over to you.
Thank you, Nancy. It's really our pleasure to present. This has been a popular topic without a doubt. As you said, most of my background is kind of in HR consulting and HR advisement, so this is somewhat related to that, but also a little bit of a departure. But in working with small and medium-sized businesses on their employee retention credits, it's been some of the most rewarding work of my career, just being able to help out businesses who are undoubtedly impacted by the pandemic, and in many cases continue to be impacted, and finding some pathways to get them some additional sources of funding. So just a quick little piece about MP, where I'm coming from. We're a human capital management service company. We offer HR, payroll, benefits, time and attendance, compliance, recruiting, all of that fun stuff. Work with clients all over the country, but especially those in the New England area. Again, everything from 1 employee companies to 1,000+ employee companies. So I'm looking forward to sharing our insights on this topic. Should you have any questions at all during the session, please feel free to use the Q&A in Zoom. You should see it on your bar there in the Zoom app. So feel free to type away any questions. We're happy to address those. Hopefully we can answer them live. If it's something that requires any additional research, we will do so and get back to you. But we have been doing this work for businesses for about 1.5 years now, and we've been able to help businesses collectively realize almost $100 million, excuse me, in employee retention credits. So we've seen quite a bit. So hopefully we'll have an answer to any questions you may have. So in terms of what we'll be talking about in today's session, we're going to go over the eligibility guidelines, and they do differ for the 2020 program and the 2021 employee retention credit program. So we'll make sure that everyone's clear on how to define the eligibility. We'll go over some other key terms and definitions so that we're all talking the same language. We'll talk about guidance that the IRS has provided in terms of what's okay and what's not okay, and how to go about doing this the right way. We'll go over some of the more frequently asked questions that we receive on this topic. We'll go over a couple example scenarios, so that may or may not relate to you in your business, and it may help shed some light on your potential eligibility. And then we'll go over some key facts and figures as well. And as always, open it up to any questions you have. So in terms of the history of this program, ERTC, although it's only really been talked about for a year and change, it was actually a part of the very first stimulus bill that was passed by Congress back in 2020, in April of 2020. The reason why people weren't talking about it out of the gate was, at the time of its inception, the PPP or Paycheck Protection Program loans were also rolled out as part of that same bill. And back then, the rule was if you were a PPP recipient, you could not also participate in the ERTC program. So that almost everybody went with the PPP loans at that time. That was usually the wise move. So people kind of left ERTC by the wayside. That all shifted at the very end of 2020. So December of 2020, I believe it was, is when the second stimulus bill was passed. There were some significant changes to this program once that second bill passed. The most important of which is it removed that disqualification of PPP borrowers from participating in this. So then all of a sudden, you are no longer disqualified from doing the ERTC program if you also had a PPP loan. There are some double dipping rules and some navigating you need to do so to make sure you're not claiming credits for both programs on the same wages, but it did create a potential for eligibility for businesses. They did also extend the program into 2021 with some increased credit amounts, which we'll talk about in a second. Also expanded the eligibility. The 2021 program has a lower bar of entry than the 2020 program did. Again, they extended it into 2021, and as I said, disqualified the PPP disqualification. And then finally, the last significant changes to the program were via the American Rescue Plan, which came out in early to mid 2021. So the second stimulus bill provided ERTC for the first 2 quarters of 2021. ARPA extended that to the final 2 quarters of 2021. It is important to note that Congress did go back and eliminate Q4 2021 ERTC. So as of right now, as of July 2022, there is not an ERTC program for the fourth quarter of 2021, but the other quarters still remain. And there are still several groups petitioning Congress to reinstate Q4. So it's not completely out of the question, but as of right now, ERTC is limited to the 4 quarters in 2020 and the first 3 quarters in 2021. ARPA also introduced a couple of new categories of businesses potentially eligible for ERTC in a little bit different way. The first is severely distressed businesses. So this is a category that I hope no one on this call falls into. This would be companies who have sustained a 90% or greater reduction in gross receipts compared to pre-pandemic times. It opens up some additional eligibility for those folks and ignore some of the usual caps that businesses face when claiming these credits. The other program that more businesses have been able to take advantage of is what's called a recovery startup business. So these would be businesses that started operations in February of 2020 or later. So they had to be new businesses as of February of 2020 or later. And their gross receipts in any given year, their annualized revenues would need to be under $1 million. If there is a business that qualifies under those as a recovery startup business, they do not need to meet any of the eligibility requirements for ERTC, so they do not need to show any decline in gross receipts, and they do not have to prove that they were subject to any restrictions on their business. Recovery startup businesses are eligible for Q3 of 2021, and they are the one business that does have eligibility as of right now in Q4 of 2021. So they can claim a credit of up to 70% of their employees' wages, up to $10,000, so up to a $7,000 credit per employee, with a cap of $50,000 per quarter. So a recovery startup business can have a ERTC of up to $100,000 across Q3 and Q4 of 2021. ARPA plan also created some guidance around some of the other stimulus programs that came about later on. So just to avoid double dipping with PPP, similarly, the ARPA prohibited double dipping when it came to restaurant revitalization grants, shuttered venue grants, and emergency FMLA money. So again, none of these programs, if you did receive any of these the programs. They do not disqualify you from also doing ERTC. You just have to make sure that the same wages aren't used for both. So if you used some shuttered, if you're a theater and you received a shuttered venues grant and you use some of it towards payroll, let's say your April 2021 payroll was paid with shuttered venues grant money, you wouldn't claim ERTC on that April payroll. So IRS kind of oversees this whole program in terms of getting the claims in, creating the refunds and sending them out. They've been fairly good about providing guidance and clarifying questions. The language for the programs and the bills and the laws themselves has been fairly vague. So it's really been up to the IRS to clarify some things that really weren't straightforward when it comes to the letter of the law. So they've done a pretty good job of doing that. There's been hundreds and hundreds of pages of IRS guidance that's come out between 2020 and now. So we've sifted through all of it, and it's helped a great deal in determining when there's eligibility and when there isn't. So some of the IRS guidance that's come out to date and provide some clarification, first of which is on suspension of operations. So the way that the bill is written, you qualify if you either had a qualifying decline in gross receipts, and we'll go over that math momentarily, or if you had a full or partial suspension of operations. So initially it was really difficult to determine what. It's clear if you've had a total shutdown of suspension of operations, if you weren't allowed to be open because of COVID regulations and you were forced to shutter your doors. But that partial suspension of operations really opened things up and created more questions than answers. So luckily the IRS came in and defined it a little bit further. So what they said was that a partial suspension of operations occurs when a portion of your business that accounted for more than a nominal aspect of your operations, and then they further define that as 10% or greater of either your pre-pandemic 2019 revenues were a piece of that portion of the business that was suspended, or 10% or more of your payroll hours were dedicated to that function. So some examples of partial suspension of operations would be, the easiest example is a restaurant. So, at some point during the pandemic, restaurants were allowed to be open, but they were considered partially suspended because the in-person dining was limited. At one point they had to be at 25% capacity. At another point it was 50% and then 75%, or you had to have the tables spaced at a certain distance. The rules varied by state, but any of those restrictions that prevented the dine-in portion from being able to happen qualifies as a partial suspension of operations. Similarly, we worked with a lot of breweries, and some of them did not have a decline in revenues. They were able to make up what they missed by doing takeout sales, 6-packs and growlers and all of that. But because they did have a tap room, and the tap room was more than a nominal piece of their business before the pandemic, because they were not allowed to have people sitting and drinking at the bar for that time period that was disallowed, that counts as a partial suspension of operations. So outside of food and beverage, there are several other examples of what can count as a partial suspension of operations. At a 10,000 foot view, it's basically things that, because of government regulation, not because of a best practice or an abundance of caution, that you weren't able to do and really weren't able to fully replicate virtually. So it gets a little bit more difficult when we're talking about an office setting. So if there was an office setting or something similar, and you were then able to replicate the work and still get the work done just with people working from home, the IRS has generally said that is not a suspension of operations because you were able to replicate it virtually. Similarly, in the retail world, they've said if you had capacity limits within your store, but really the impact was customers having to wait outside for a brief while until they were allowed in, until the capacity reached the acceptable level, that doesn't quite meet the bar of a suspension of operations if they just required a brief wait. So these are certainly on a case-by-case basis, and and are interpreted based on the facts of every individual business. In terms of claiming the credit, we're amending a return. We're providing a very brief explanation there. And you're not required to write a novel explaining yourselves when it comes to submitting the credits, and the IRS, albeit slowly, is processing all of the credits, but they do reserve the right. They give themselves a 5-year window to inspect or audit any of these. So what you want to do, what we do when we work with clients on these, is kind of write out a narrative explaining your case. If it was a gross receipts decline, that's very black and white. If your eligibility is based on your suspension of operations, you just want to have some justifications. Point to the federal, state, or local law that you are restricted by, and the time period, and the impact that that had on your business, and just kind of sock that away in your files in case anyone ever asks. Through IRS guidance, we also got clear direction on how these claims are to be submitted. These are claimed as a credit on 941s for the quarter in which the wages existed. So you can't put all of your quarters all on one amended 941. You have to do separate 941Xs for each quarter where you had eligible wages. And unfortunately, the 941X is not a tax form that can be submitted electronically. So we do have to create paper forms and snail mail them to the IRS. And it can be an extended wait to get the money back, but what we do is we track it via IRS transcripts to confirm receipt, and then keep monitoring those until a refund is reflected. For businesses who have a greater than 50% owner of the company, the IRS, there was some language that created quite a bit of debate in the accounting world about who was eligible and who was not eligible. For businesses with a 51% or greater shareholder or owner, anyone who owns more than 50% of a company and is on the payroll is not eligible as an employee. Their employees are still eligible, but you can't claim a credit on the owner's wages, nor any family members of the owner. So if someone is the 100% owner of a business and they're on the payroll, we couldn't count credit for their wages, nor any of their family that's on the payroll either. There are also aggregation rules with this program. So if you are part of what the IRS views as a control group, let's say you have 2 restaurants with the same common ownership, or you own 2 completely unrelated businesses, a hair salon and a restaurant. If the ownership is the same or majority ownership is the same, then those businesses have to be aggregated. And there's some upside and some downside to that. The upside is that when it comes to the restrictions, if one of the businesses is restricted, let's say we're going off of, instead of a hair salon and a restaurant who had similar restrictions, let's say you had, a traditional office company and then a restaurant. Because the restaurant was partially suspended and subject to those restrictions, the entire control groups and all the employees' wages would be eligible. So even though the office wasn't suspended, because more than a nominal function of the entire 2 Fed ID organization was restricted, all the employees would be eligible. On the downside, you do also have to aggregate gross receipts. So if you're being eligible based on gross receipts decline, you have to get a you have to combine gross receipts from both organizations and measure the decline of both combined. So, as I said, there are 2 separate pathways to being eligible for employee retention credits, and you only have to meet one of these. You don't have to both have been restricted and have a gross receipts decline. It can be one or the other. So as we were just talking about, if you are subject to those restrictions, again, they can be federal, state, local, that for that time period that those restrictions were in place, your business would be eligible. Or if you've experienced a significant decline in gross receipts when compared against the same quarter in 2019. So you're always comparing against 2019. So to be eligible in each quarter in 2020, the gross receipts decline when comparing a same quarter in 2019 against 2020 would need to be at least 50%. So your gross receipts would need to be reduced by 50% or more compared to 2019 to be eligible. For the 2021 program, your gross receipts decline only needs to be 20%. So again, you're comparing against 2019, but if your first quarter of 2019, if you saw a 20% or greater drop in that same first quarter in 2021, you would be eligible for that quarter. As you see in the asterisks on the screen, there's also what's called the preceding quarter rule. So you're allowed to look back at the previous quarter for your eligibility in 2021, which means because your first quarter 2021 was down more than 20%, that also automatically makes you eligible for second quarter because you're allowed to look at first quarter for your eligibility. And another important qualifier when it comes to this program is being considered a small business by definition of the program. And that definition changed dramatically between 2020 and 2021. In 2020, large employer was defined as 100 full-time employees. And similar to the receipts decline, you're always using 2019 for your count for this. So what you need to do is take a look at your 2019 payroll and count on average how many 30 or more hour per week employees you had. You don't have to count partial employees or part-time employees as an equivalent. You're only counting the actual full-time workers. If that number was over 100 in 2019, you'd be considered large, and it would limit what you can claim in 2020 ERTC. You'd only be able to claim credits on wages that were paid to employees who did not perform work. So in most instances, what that means is employees who were on a furlough, if you were providing them any type of payment, or if you were continuing their health benefits, you could count the employer portion of that as wages paid and claim a credit on that. But otherwise, if you were over 100 full-time employees in 2019, that would be what you could claim for 2020 ERTC. That threshold jumped all the way up to 500 full-time employees for 2021. So as long as you were under 500 full-time employees in 2019, you'd be able to have otherwise full eligibility for 2021 ERTC. Another key difference is in the actual amount of credit that you're eligible for. So for the 2020 program, you're kind of combining all of the quarters when it comes to adding up the maximum credit. So for each employee, the credit is 50% of wages up to $10,000 or $5,000 per employee. And whether that's all in one quarter or spread out over several quarters, the most you can claim an ERTC for any one employee in 2020 is $5,000. The 2021 program shifted that to a 70% credit, meaning up to $7,000 per employee, and created a separate program for each quarter, which means that if you were eligible for quarters 1 through 3 in 2021, you could be getting up to $21,000 per employee in ERTC. Now, the potential eligibility period for the programs for the 2020 credit, that program started on March 13th, 2020, so any payrolls dated then or later through the end of that year. So that's the eligibility period. They don't have this program open for any payrolls dated prior to March 13th of 2020. That's kind of when they consider the pandemic really starting. Then for 2021, the program runs from first quarter through the end of third quarter. Again, fourth quarter was on the table briefly, but it was disqualified. All right, so let's go over some key definitions. First of which is the wage period. So again, based on other programs through the IRS, we use the rule of constructive receipt, which means the check date. So we're always going by the check date. So checks dated that could be eligible would be any checks March 13th through September 30th of 2021. The next would be qualified wages. So in terms of what you can count in claiming this credit, getting towards that $10,000 max in wages per employee, it can include hourly wages, salaries, commissions. For those of you that are in food service, you can count tips as well. Basically, any compensation that's subject to Social Security and Medicare tax is considered qualified wages under this program. Gross receipts. So again, this is an important calculation. It includes total sales, all amounts received for services, also includes interest, dividends, rents, royalties, and annuities. So you're really looking at everything, truly your gross receipts that are being reported each year. And you want to have that divided up in a quarter by quarter basis to determine which quarters may be eligible if that's your route for eligibility. So when it comes to determining which quarters are actually eligible, if you're going on gross receipts, what you do is you find the first quarter where you had a 50% or greater decline in 2020 versus 2019. Your eligibility would then continue even if you have quarters that are less than a 50% drop until you have a quarter in 2020 where the drop was less than 20%. So I'll go over an example in a second so this is a little bit more clear. And then once you have that quarter that's less than a 20% drop, you're still eligible in that quarter, but you would lose eligibility for the quarter following. So in my example here, this business was down 52% in quarter 2 of 2020. So that quarter is eligible for credits. In quarter 3, they bounced back and they were only down 17%, so no longer down at least 20%. Under the 2020 rules, they're still eligible to claim credits for that entire quarter. But in quarter 4, they had lost their eligibility. So this example here, based on the gross receipts, not knowing what restrictions were in place, this business would be eligible for ERTC for quarters 2 and quarters 3 of 2020. All right, so some of the more common questions we've been receiving through the course of this program. A lot of questions about automating the 941X process. Again, this is how the credit is claimed. The IRS has not budged on this. Their software isn't set to handle electronic submission of the 941X, so at this time those are all still being filed by paper. In terms of the turnaround time on this, it can vary greatly. Once they're submitted, generally the earliest that refunds are issued are 4 or 5 months after submission, and that can sometimes extend to 9 or 10 months. Does an employer need to prove that their decline in gross receipts was related to COVID-19? No, they don't. So I worked with a business who wasn't really subject to too many restrictions, but they had 3 locations of their business, and during 2020 they sold one of the locations. So all of a sudden, kind of a third of their revenues were down. So when you compare the gross receipts in 2019 when they had 3 locations to their gross receipts in 2020 and 2021 when they only had 2, there was a sufficient decline. So they were eligible even though it wasn't related to COVID in terms of the decline in gross receipts. Again, in terms of determining your employee count for ERTC, you can claim credit on all wages, full-time and part-time employees, but your definition in terms of your size will be based on how many full-time employees you had. So again, as long as that's under 100 when talking about the 2020 program and under 500 when talking about the 2021 program, you're safe as a quote-unquote small business. What if my credit exceeds my tax liability? So yeah, we have had some really fortunate cases with some businesses where they've been eligible for tens of thousands, hundreds of thousands, even a couple over $1 million in ERTC credits. Good news there is that the ERTC is a fully refundable tax credit. So what that means is we're going to be claiming credits on, the first few quarters in 2020 and the first few quarters in 2021. Those taxes have long been paid by you. So there's no outstanding tax liability for those quarters that needs to be addressed. So what that means is whatever's calculated for your ERTC, we send off to the IRS and they send you back that full amount, and oftentimes plus interest. So if your ERTC is calculated to be $50,000, we submit that on the 941X tax form, but you should then expect to receive a full $50,000 check back by the IRS. And these are done via paper check, so they don't do direct deposit for this or anything like that. They will send a physical check in the mail. What they'll generally do is first, a couple days ahead, send a letter to you talking that you have an overpayment on your taxes, which is really this credit, and then that'll be followed up by an actual check. think we went over this pretty well, but if there are any questions, given your specific situation, there can certainly be a lot of gray area and a lot of uncertainty when it comes to what's considered a qualifying suspension of operations. We're happy to discuss that with you, or feel free to shoot a question here and we can boil it down together. But yeah, generally speaking, it's something that was more than a nominal piece of your business. Thinking back to some of the IRS scenarios, again, the retail one, they kind of shot down a little bit unless they were, basically in the retail example they used, they said for the time where they had to be completely closed and could only do curbside service, they weren't allowed to have customers in their store. And again, not as a precautionary measure, but because of a regulation, that time counted as a suspension of operations. But for the time when they had capacity limits and people had to wait outside for a little while, that did not. Similarly, an example they used when describing the whole nominal definition, they used the example of a grocery store and the salad bar being restricted, that the government in that area prohibited the salad bar from being operational, but because that didn't account for more than 10% of their revenues or 10% of their staffing, that is considered a nominal piece of their business, and the salad bar being the only restriction would not qualify them. All right, so there are some decision trees that we have available should you be interested to kind of help you determine your eligibility. Again, some of these can be a little trickier, so sometimes it behooves you to have a live conversation with someone, but basically you want to kind of both examine your gross receipts and then as well as the restrictions you are faced to determine if you may be eligible. All right, so let's finally go over a couple of scenarios that are similar to ones we've run into in real life. For a nonprofit educational program whose services were able to be done remotely in part. So let's say it was an after-school program. They did some stuff virtually, but there were other programs that had to be canceled. It might be like a physical ed thing or a sport thing or some kind of more formal child care program that they weren't allowed to have, or at least have fully at full capacity, then this educational program would be eligible. The restrictions that they did have were more than nominal, even though some of their programs could continue, some couldn't, or at least couldn't continue at full capacity, so they would be eligible. A tech company, all office staff were required to work from home. The job was able to be done successfully, and also many employees still remain working remotely, even though the restrictions are no longer in place. This is an example that would not generally qualify because they aren't able to show any restriction on their operations where the job could be done remotely. Third, a brewery. They've got 3 production facilities in 3 different states. One of the locations had a tap room that was forced closed through Q2 of 2021, but overall their gross receipts were up. Again, assuming that tap room accounted for at least 10% of the organization's staffing or at least 10% of their revenues in 2019, all 3 production facilities and all the employees of that brewery would be eligible for the time that the restrictions were in place. So when we talk about the time that the restrictions were in place, it is important to note that there is a hard stop when those restrictions are lifted. So here in Massachusetts, most of the restrictions were lifted as of May 29th, 2021. So in those cases, we can continue to claim credits up until payrolls dated May 29th, 2021, but we can't extend it to the end of that quarter without a gross receipts decline. Once the restrictions are lifted, the eligibility ceases for the organization. Controlled ownership group, a husband and wife fully own a auto body shop and a restaurant. The garage accounts for 70% of the revenues and was an essential business. They weren't subject to restrictions, but the restaurant was. So even though it was only 30% of the entire group, it's more than nominal. So all the employees of the restaurant and all the employees of the auto body shop would be eligible for ERTC because based on the restrictions, without even looking at the gross receipts. But important to note, the husband and wife, their wages would not be eligible, nor would any of their family members who may appear on payroll. Next example is a gym or a fitness center owned by 3 college friends. They each own a third of the company and are on the payroll. So in this instance, gyms were certainly subject to restrictions and would have a period of eligibility. And because the owners are not at all related and none of them own more than half of the company, their wages would be eligible in this scenario for ERTC as well. Now, if 2 of those owners were spouses or had another qualifying relationship, it might be a different story. Maybe only the third owner may only be eligible for his wages or her wages, but in this example where they're not related, all those owners' wages would also be eligible. And then finally, a museum. So they had fundraising and grants that helped them avoid sufficient losses during the restrictions. The restrictions in their case were lifted on June 1st, but people were slow to return to the museum, so the revenues fell short in Q2 and Q3 of 2021. So this is an example of mixing and matching, which is completely acceptable. So the museum wouldn't qualify on gross receipts, but did qualify on restrictions all the way up until the restrictions were lifted 6/1, and they could then switch their eligibility to gross receipts for those final 2 quarters of the program. So it's completely fine to do it that way, to mix and match in that manner. Where things get especially tricky when it comes to calculating these credits are when you had a PPP loan like many businesses did. So again, what you need to do is really navigate what time period your PPP was, what the amount was, and most importantly, how much of it on your forgiveness application did you apply as payroll costs? And that's what needs to be excluded. So if you say got a $100,000 PPP loan, and you said 75,000 of it was payroll costs, that's what you need to exclude and can't claim ERTC on. So you can navigate before that time period and after it and kind of combine your numbers and maximize the credits. That's what we do here at MP. But you just have to make sure you exclude that time period that wages were being paid with PPP funds. So in terms of takeaways and things to think about as you consider potential eligibility and taking advantage of this program, do familiarize yourself with the differences between 2020 ERTC and 2021 ERTC. Again, just because you may not have been down 50% and may not qualify for 2020, you still may qualify for 2021. You want to understand your employer size, realize that it's all about your payroll figures in 2019 and what that means to your eligibility. You want to be able to accurately know what your gross receipts were in all 4 quarters of 2019, 2020, and the first 3 quarters of 2021. You want to have a good understanding, or at least know what questions to ask to determine if you had a qualifying restriction or suspension of your operations. You want to have a good understanding of the ownership breakdown of your business or businesses so that you can understand what limitations there may be on owner payrolls, as well as limitations or aggregation requirements if you own more than one business. You want to be able to maximize, as I just said, around your PPP loan, so really understand how to take full advantage of that and not disqualify any more wages than you absolutely have to. You do want to keep proper substantiation, so if you're qualifying based on gross receipts, have record of that handy. If you're qualifying based on suspension of operations, have your narrative in order. 9, you want to please do know this isn't too good to be true. Again, we've helped hundreds of companies with this program and helped again get over almost $100 million now in ERTC credits for those businesses, and businesses are receiving checks on a regular basis. So this is for real, and it is happening. And then lastly, you do need to have a little bit of patience. The IRS has been staffing up to weather the storm when it comes to these, but they are taking quite a while to get the refunds issued. But we are seeing the pace actually pick up a little bit over the last few weeks, so we're monitoring it closely, but it does require some patience in terms of waiting for the check to hit your mailbox. Okay, do we have any questions? Doesn't look like any have been submitted at this time. We do have a recording of this. I believe it will be distributed to everyone if there is something you want to take a look at that you may have missed the first time around. It is a lot of information. It is a lot to digest. But once you sit down and look at it from your perspective and your business, and no one knows better than you as a business owner what you went through during this pandemic. And in so many cases, there is at least some period of eligibility for many businesses. So it's a great program. It's something that businesses should take a look at and take advantage of whenever possible. Oh, a really good question just came in. For eligibility, does PPP need to be included in gross receipts calculation for that quarter? Excellent question. And a great answer is no, it doesn't. So that was another piece of IRS guidance that came in down the line. When you're calculating your gross receipts from 2019 against 2020 or against 2021, you do not need to count your PPP loan that you received as gross receipts. So that can be eliminated from the equation, which is really nice. So that did inflate gross receipts for some businesses because they needed that funding, but you do not need to count that in your gross receipts calculation. All right.
Well, I don't see any other questions myself. So Paul, I want to say thank you to you. I want to say thank you to your coworkers, Jay, Katie, and Sam for coordinating this webinar for us. Hopefully we're going to be working together in the future to put a lot more educational webinars together on different topics. So we look forward to that. And like you said, a lot of information. Thanks for helping to somewhat simplify it all for us. But I definitely encourage folks to call MP directly to go over your specifics. And again, if there's no other questions, I thank you, and we will get this information out to all of our business members.
Awesome. Thank you so much. And it was a pleasure working with your groups, and happy to help however we can.
Thank you. Everyone have a great day.
Thank you.